Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we're sharing 5 stories. First, Apollo Global CEO Marc Rowan claims the public stock market is broken and that with over $8 trillion in private equity, the very definition of a safe investment has been flipped. Second, German software giant SAP is spending over 20 billion euros on a sovereign cloud, a direct challenge to Amazon and Microsoft by keeping European data safe from the US. Cloud Act. Third, we'll look at Amazon's Prime Day. While CEO Andy Jassy called it the biggest ever, internal data shows US sign-ups actually fell, missing a secret target by over 100,000 new members. Fourth, a Norwegian startup Aviant is delivering burgers to nearly 200,000 people in delivery dead zones thanks to some clever tech and new EU rules. And fifth, how the Bristol City Council sparked backlash from artists after using AI to design a booklet cover. The dead giveaway was a woman with only 4 fingers, raising fears about model collapse. The CEO of a global investment firm with nearly $1 trillion in assets just went on the record with a bombshell statement. The traditional way you invest is, in his words, broken. Apollo Global CEO Marc Rowan is claiming that the investing world is in the middle of a tectonic shift. He asks, "We had this notion 40 years ago that private was risky and public was safe. What if that's just fundamentally wrong?" His argument is that the public stock market is shrinking. The number of listed companies has been cut in half, from 8,000 in the 1990s to only about 4,000 today. Now, what's flying under the radar is that this isn't an accident. Companies are actively choosing to stay private for longer or forever. Why? First, going public is incredibly expensive and comes with massive regulatory burdens, thanks in part to laws like the Sarbanes-Oxley Act. Second, and this is the key, there is a colossal ocean of private money available. In 2023, private equity funds managed over $8 trillion, more than double the amount from just 5 years earlier. Companies like SpaceX and Stripe can raise billions without ever needing to list on the stock market. And what's left on the public market is dominated by a tiny handful of giants. Rowan points out that just 10 stocks now make up a staggering 40% of the SP 500 index. He says investors have lost the ability to truly invest in the broader economy. So where is the money going? Into the private markets, and the numbers are jaw-dropping. Firms like Apollo, Blackstone, and KKR are muscling out traditional banks. Together, they now manage over $2.6 trillion in assets, a 4-fold increase in just a decade. Apollo alone has exploded from $40 billion in assets to $840 billion since 2008. This isn't just about numbers on a spreadsheet. We're talking about a massive concentration of power. With a few private firms controlling trillions in capital, they become the new gatekeepers of finance. They decide which major corporations get funding and which don't, influencing everything from corporate competition to innovation. This shifts accountability away from transparent public markets and into the hands of a few private decision makers. And if you think this is just for small, risky companies, you're wrong. Corporate giants like Meta, Intel, AT&T, and Air France are now turning to firms like Apollo for massive loans, not the big banks. Believe it or not, this is a direct consequence of the 2008 financial crisis. New regulations were put in place to make the banking system safer by forcing banks to hold more capital and be more cautious with their lending. The result? Much of that lending activity didn't disappear. It just moved into the less regulated private credit market, often called shadow banking. The big concern for economists is that we haven't eliminated risk. We've just transferred it to a system that operates with less transparency and without the same government backstops that protect traditional banks. Rowan says this is just the beginning. He claims the private credit market isn't a $1.5 trillion opportunity, but a $40 trillion one. It's a power struggle for the future of finance, with private giants challenging the entire public market system. It brings us right back to the question he posed himself: what if the very definition of a safe investment has been flipped on its head? We just heard about a massive power struggle in finance, and that theme continues in the tech world. A German software giant just announced it's spending over 20 billion euros. That's more than 23 billion US dollars. And the real story is who they're targeting. The company is SAP, and they're pouring that money into something called a sovereign cloud. The goal? To build a digital fortress that ensures European customer data stays locked inside the European Union, fully compliant with strict data laws like GDPR. This is a direct challenge to the current kings of the cloud, American titans, Amazon and Microsoft. But that's not the whole picture. The real turning point is a US law called the Cloud Act. It allows US authorities to demand access to data held by American companies, no matter where in the world it's stored. This creates a massive legal conflict with Europe's GDPR. So when SAP, a German company, promises a cloud where data stays in the EU, they're offering a legal shield that their American competitors simply cannot match. It's a huge competitive advantage. This isn't just a business move, it's a declaration. As an SAP board member put it bluntly, innovation and sovereignty cannot be two separate things. It needs to come together. This signals a massive shift driven by rising geopolitical friction, with countries scrambling to reduce their reliance on foreign technologies. And their ambition goes even deeper. SAP is now entering the infrastructure as a service market, a space dominated by those same US players. This is a massive gamble. SAP has always been a software company. Building infrastructure means pouring billions into physical data centers and networking on a global scale. They are now going head-to-head with giants like AWS and Azure, who have spent over a decade and hundreds of billions of dollars building out their global infrastructure. They're even offering to install SAP-operated infrastructure directly inside their customers' own data centers. Now, you might be asking, who on earth needs that? The answer is customers with the absolute highest security needs. We're talking about government defense agencies, intelligence services, and critical financial institutions. For them, it's not enough for their data to be in the right country. It needs to be inside their own physical guarded buildings. This private sovereign cloud is SAP's direct answer to hybrid solutions like AWS Outposts and Azure Stack, but with an extra layer of data residency armor. Let's start with a single statistic that might just change your entire perspective on this company's ambition. That 20 billion euro investment happens to be the exact same amount the entire European Commission plans to invest in its own so-called AI gigafactories to compete with the US and China. The EU's plan relies on a public-private partnership model, but SAP is putting up that same amount all on its own. They aren't just following a trend, they're matching the ambition of an entire continent's governing body. This decision, however, brings both the benefit of technological sovereignty and comes with the inherent risk of what some are calling the balkanization of the cloud. Instead of a seamless, connected digital market, Europe could end up with fragmented data silos, making it harder for companies to work together and increasing the risk of being locked into a single vendor. It's a paradox where the quest for independence could inadvertently create new walls, begging the question, are we watching the start of a new global arms race for data, for AI, and for technological independence? While one tech giant is making a bold play for the future, another seems to be showing some cracks in its armor. Amazon just told the world its Prime Day was the biggest ever, but newly revealed internal data tells a very different story. When a company like Amazon says biggest ever, they're often talking about one specific metric, like total sales volume. But what investors and analysts are really watching is something else entirely. New subscriber growth. And that's where the numbers get really interesting. Believe it or not, despite doubling its massive Prime Day sales event to 4 full days, Amazon's US Prime signups actually fell short of last year's total. Internal company documents show the retail giant missed its own secret target, registering 116,000 fewer new members than the previous year. The miss was even worse in the crucial 3 weeks leading up to the event, where signups fell nearly 200,000 short of their internal goal, a stunning 5% miss. For a company built on a model of perpetual growth, a 2% year-over-year decline in signups during its biggest marketing push of the year is a major red flag. This is where the situation takes a more complex turn. All this happened right after CEO Andy Jassy publicly celebrated the event, claiming record-breaking signups and calling it Amazon's biggest ever. So how can both of these things be true? It's a classic case of what some are calling narrative versus the numbers. The company can truthfully say it was the biggest ever in terms of global sales, while internally, the numbers for new US subscribers, the lifeblood of their domestic market, are telling a very different story. So the thing is, Amazon is starting to bump up against the ceiling. Research shows Prime has reached an incredible level of market saturation in the United States, with some estimates suggesting that a staggering 80% of all US households already have a Prime membership. when you've already signed up, almost everyone finding new members gets a lot harder. The numbers really prove why. A Prime member spends an average of $1,170 a year on Amazon. A non-member spends just $570. That's less than half. Prime is the golden goose, driving nearly $24 billion in subscription revenue in just the first half of this year. But now, for the first time, we're seeing a crack in the armor. What really brought this to a head was the direct challenge to Prime's core value. For years, 2-day shipping was the killer feature. But now you have competitors like Walmart Plus offering similar perks, including free shipping, grocery delivery, and even a streaming subscription with Paramount Plus, all for $98 a year. That directly undercuts Prime's $139 price tag, forcing customers to ask if the extra cost is still worth it. Is the magic of Prime Day finally starting to fade, or is this a warning sign of a much bigger challenge ahead for the retail giant? Speaking of the challenges in retail delivery, our next story looks at a solution that sounds like pure science fiction. Right now, there are nearly 200,000 people living just miles from major Scandinavian cities who can't get a hot meal delivered to their door. While city dwellers take it for granted, these suburbs are a delivery dead zone. A Norwegian startup named Aviant is looking to change that, and their solution is using drones to fly burgers from the restaurant chain Bastard Burgers over water and land directly to homes on islands like Värmdö, just outside Stockholm. You might be wondering, how is this even legal? Well, it's taking off in Europe thanks to a risk-based regulatory framework from the European Union Aviation Safety Agency. This allows for what's called beyond visual line of sight operations in semi-populated areas, as long as operators prove it's safe. This is the key that unlocks the whole business model, and the reaction is electric. The company's CEO says people go crazy for it. They call their neighbors and their grandma. They think it's like a UFO delivering their food. But getting there wasn't easy. He admits that after 3 years of testing, their biggest initial problem was a simple one: soggy fries. The engineering challenge here is actually immense. To keep food perfect during a flight with changing temperatures and altitudes, you need innovations in active packaging. Think self-heating containers or smart systems that adjust the internal environment to keep fries crispy. Solving the soggy fry problem is a major technological hurdle for the entire industry. Now, with improved containers, they're preparing for a massive rollout. Aviant has identified 87,000 people near Stockholm and another 100,000 near Oslo who currently have no delivery options. They plan to launch 40 drone bases across Scandinavia in the next 2 years and are even eyeing similar geographies in Canada and the US. Of course, scaling this up has some real second-order effects we need to consider. We're seeing a fascinating duality. On one side, drones can be incredibly efficient, using up to 94% less energy than a diesel truck. On the other, it exposes the question of noise pollution and what hundreds of these flying overhead daily will mean for suburban quality of life. Here's where it gets interesting. This isn't about delivering to the most remote places on Earth. Other companies are tackling this viability problem with a different strategy called the anchor customer model. The idea is to secure a primary high-volume client, like a national postal service, to deliver mail or medical samples. Those consistent flights then subsidise the cost of consumer food delivery. For example, in the UK, the Royal Mail is already using drones to deliver mail between islands, cutting delivery times by a full day. Aviant's killer insight is targeting the space between urban and rural areas too difficult or expensive to serve by car. When we place the cost of a drone alongside a traditional car delivery for these specific routes, the business case becomes clear. Early Amazon drone deliveries were estimated to cost hundreds of dollars, but that's projected to drop to as low as $63 by 2025. While still more than a car in a dense city, Aviant's bet is that for these specific suburban routes, the drone is the cheaper, faster option. That's the sweet spot they're aiming for. The battle for your dinner is no longer just about speed, it's about geography. And with a 90% service uptime, even in rough weather, the question is no longer if this will work, but how soon a drone will be landing in a suburb near you. From a technology that's solving logistical nightmares, we turn to one that's creating an ethical one. A city council printed 72,000 booklets to promote its creative courses for adults and used artificial intelligence to design the cover. Artists immediately called them out, and the dead giveaway was exactly what you'd expect. One illustrator pointed to the classic AI mistakes, noting the woman on the cover has only 4 fingers and what appears to be 7 toes. The reason AI makes these mistakes is actually a fascinating look at its limitations. It's not that the AI is bad at art. The problem is that these models are trained on billions of 2D images, so they have no real-world, three-dimensional understanding what a hand is. They're just matching patterns. Since hands are incredibly complex and often partially hidden in photos, the AI doesn't have enough clear data to learn from. It can mimic, but it doesn't truly understand anatomy. The move sparked backlash from the very community the courses were for. One designer, Adam Birch, put the core conflict in a single powerful question for the Bristol City Council. Why learn these creative skills if, right on the face of the book, you're devaluing the use of it? This gets to the core question, why are organisations choosing flawed AI over a simple, authentic photo? The answer is a massive shift towards valuing speed and cost above all else. Some major companies report that using AI for marketing images cuts production time from weeks down to just days and can slash costs by up to 90%. It's a powerful incentive, even if the result feels a little soulless. As Birch says, what you're doing is wiping out a job. However, if you zoom out, you'll see another layer to this problem, a hidden danger that scientists call model collapse. The concept is this: when AI models are trained on art made by other AI, is they start to lose quality. Over time, the AI just learns from its own weird mistakes and the outputs get more and more distorted and less diverse. So by devaluing human artists, we risk creating a future where the AI itself becomes worse, trained on a shrinking pool of unoriginal synthetic content. And this artist isn't alone. We're seeing a huge clash happening inside companies right now. The pressure is coming from the inside. An artist who chose to remain anonymous revealed his own CEO is now telling the company's creative team to bring our heads out of the sand and start using AI. One report found that nearly half of all CEOs admit they're facing resistance or even hostility from employees over AI adoption. The C-suite sees a path to efficiency, while the creative teams on the ground fear for their jobs and the integrity of their craft. The artist's response? He and his colleagues see it as the opposite of what we should be doing. While the council says it's now updating its AI guidelines, that anonymous artist left us with a thought that captures the entire debate. He said, AI is fast food. We never stop to think about whether we should, it's always whether we could.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.